Let's face it, in today's fast-paced world, money decisions feel overwhelming. Inflation's real. Jobs are unpredictable, and every day we're hit with a new podcast or TikTok telling us what to do with our money. If you're feeling uncertain or even a little lost, you're not alone. Maybe you've started saving or you're just thinking about building wealth, but the options are endless. Crypto, real estate, stocks, funds. It's a lot. But here's the good news. You don't have to become a Wall Street genius to make smart investment decisions. You just need clarity. And that's what this video is all about. Today, we're breaking down one of the most common yet confusing choices in personal finance: index funds versus individual stocks. Which one is right for you? Now, this isn't going to be another boring financial lecture. No jargon, no fluff. Just straight-up real talk, based on facts, history, and what actually works. Whether you're a student in London, a new dad in Texas, or planning your retirement in Toronto, this guide is for you. We'll look at risk, returns, simplicity, and even emotional stress. Because investing isn't just numbers, it's psychology too. So grab a coffee, take a deep breath, and let's get to the truth behind this important decision. In a way that finally makes sense. Let's start with what really separates these two investment styles. How much control you want, and how simple you want the process to be. Index funds. The simplicity champion. Imagine this. Instead of picking individual players in a football match, you're betting on the entire team, or better yet, the entire league. That's what index funds do. An index fund is a type of investment that automatically tracks a market index, like the S&P 500 in the US or the FTSE 100 in the UK. When you invest in one, you're not buying one stock. You're buying hundreds of companies at once with just a few clicks. Why this matters? You don't have to research individual companies. You don't need to time the market. You don't need to stay glued to financial news. It's hands-off investing, perfect for people who have full-time jobs, families, or simply don't enjoy analyzing markets. Think of index funds as a slow cooker. You set it, forget it, and over time, it delivers results. Individual stocks. Total control, total responsibility. Now let's flip the coin. Buying individual stocks means you choose exactly which companies to invest in. Apple, Tesla, Amazon. You're in the driver's seat. That gives you full control. You decide when to buy and when to sell. You can chase trends or invest in companies you personally believe in. You have the chance to outperform the market, big time. But this control comes at a price. You need to research company earnings, management, industry trends, and market sentiment. One bad decision, one poor earnings call, and your investment can drop fast. It can be emotionally draining, especially in volatile markets. In short, individual stock investing is like flying your own plane. You can go anywhere, but you better know how to fly. So, which one is better in terms of simplicity versus control? If you value peace of mind, minimal effort, and broad exposure, index funds win. If you love digging into companies, enjoy the thrill of the market, and want to build your own path, individual stocks might suit you better. But remember, simplicity is often underrated. In the long run, many professional investors underperform the market. Index funds quietly win the race, with less stress and more sleep. Let's talk about something every investor, new or experienced, must understand. Risk. Risk is at the core of every money decision. Whether you're investing for retirement, your first home, or financial freedom, you're always balancing one thing. How much are you willing to lose in order to grow? Index funds. Built-in diversification, lower risk. When you invest in an index fund, you're spreading your money across dozens or even hundreds of companies, all at once. Example: the S&P 500 includes Apple, Microsoft, Google, Coca-Cola, Nike, and hundreds of other US giants. If one company drops, the others can balance it out. This is called diversification, and it's your best friend when it comes to managing risk. Why this matters? You're not putting all your eggs in one basket. You avoid the emotional roller coaster of individual stocks crashing overnight. It's safer during economic downturns because strong companies can carry the weak. In other words, index funds offer smoother, more stable growth, even if it's not flashy. Individual stocks. High risk, high reward. Now let's be real. Individual stocks can be exciting. When you invest in a single company, your returns, or losses, are tied only to that company's performance. If you bought Amazon early, your wealth exploded. But if you held on to Blockbuster, well, you get the idea. Here's the comp.